Hi, Steve Sosnick here with today's Interactive Brokers Midday Market Update for Wednesday, June 23rd, 2021. Today is, I guess, what we would call a consolidation day. Right now, as we're taping this, markets are essentially unchanged, more or less across the board, but this is the kind of thing that one might expect after the moves we've had. It was really, quite a wild few days. And what's interesting was by the end of Monday, we more or less had like what I would call a mulligan. Think about what we went through over the past week or so. I guess really a week. Going into the Fed meeting, it was very, very quiet. Markets were pretty much near their highs and came off in the aftermath of Powell's speech. A little bit on Wednesday afternoon, a little bit more on Thursday, and then really got taken to the woodshed on Friday. I really believe that was more about Bullard's comments than anything else, and really I think about the timing of those comments, because bear in mind they came Friday morning of a quarterly expiration. Without getting too much into the mechanics of this, futures expire on the open on a Friday of expiration quarterly. And so you had S&P index futures and NDX index futures, ES and NQ mostly, expiring, among other things, fixed income as well. Those are very, very difficult to hedge. There's also various options that expire, index options and options on those futures all expire on that Friday morning, not on the afternoon like stocks and ETFs do. What that means is those are very hard to hedge. In the close, you put in a closing basket. On the open, you put in an opening basket if you were going to hedge. But particularly if you have options, that number is very dynamic. You may or may not want to hedge based on where you think it's going to open. And if it starts to sell off, there's incredibly difficult dynamics in there. And that's basically what I think drove a lot of the activity on Friday. And it kept going as the day progressed. I think markets got off on a bad foot and continued. I think with a little clearer thought over the weekend and some comments that I would say were designed by some of the Fed governors to offset some of the bearish comments that Bullard made on Friday morning, markets more or less reversed course and closed in a way that more or less pretended that Friday didn't happen. Not pretended, that's the wrong word, but essentially Friday's move was rendered irrelevant. In hindsight, it was a trading opportunity, a chance to cover shorts if you were short, a chance to establish some longs if you were trading from the long side. But other than that, if you're a long-term investor, it was just a blip and disappeared. Yesterday, we saw more continued strength. I think Powell's comments in front of Congress certainly were enough to keep investors enthusiastic, and we continue to see the markets progress thereafter. There's a lot of Fed speak coming out now. Companies, when they're about to release their earnings, have what they call a quiet period, and the management can't discuss the goings-on of the company too close to an earnings date. And the same is basically true with the Fed. The Fed governors can't really talk publicly before an FOMC meeting, and then afterwards they're pretty much free to discuss, and so we're getting a lot of Fed commentary this week. I think the feeling was that we are, the Fed is going to take a slightly more hawkish view. That said, it's hard to take a more dovish view. And I do have to wrestle with the idea now going forward of inflationary expectations actually diminished as a result of the Fed talking about an extra rate hike in 2023. In a strange way, that's actually not what they want. What they want is continued inflation expectations around the 2% level. Well, if you have a 30-year bond that's trading around 2%, that is very, very marginally 2% long-term inflationary expectation. Certainly if you have a 10-year trading around 150-ish, that's not a long-term 2% inflationary trend. And so in a strange way, what ended up happening for the Fed may not be what exactly they wanted, and that's the sort of thing that you may see commentary come out over the next couple of days to sort of work against that idea. So there may be a little more hawkish talk in terms of dovish talk in terms of inflation, because remember, what they want is sort of a 2% inflation and 2% inflationary expectations baked in. What we've seen over the past decade or more has actually been a deflationary trend, and the Fed has been working very hard to fight against that. And so I think that the markets will not be, the markets are sort of reverting to that mentality to a certain extent, saying that, taking the Fed at their word, this is transitory, and if they move to quell inflation, it'll just resume there won't be any real inflation. It assumes a lot from the Fed, but the markets essentially assumed a lot from the Fed for the last, called 12, 13 years, and pretty much gotten what it's pretty much been rewarded for that. The problem you have now, besides the inflationary expectations, but this is the broader issue, is it's much easier to put your foot on the accelerator if you're the central bankers and pump money into the system. It's much harder to tap on the brakes. Matter of fact, it's actually fairly hard, as they're finding out, to take your foot off the accelerator. Think about the taper tantrum that of a few years ago. Think about the very, very careful language that they're using now. It's very different if you're trying to I'm not even going to say decelerate, stop accelerating. Remember, the markets think, in terms of derivatives, and I'm not talking about financial derivatives here. I'm talking about calculus derivatives. Sorry. But when you think of rates of change, let me put it that way. So, inflation is the rate of change in prices. So changes in the CPI are second derivative because you're focusing on changes in the rate of change. CPI is accelerating, therefore that's the second derivative of prices. Money supply has been rising, but the growth of money supply has been at a slower rate. So the second derivative of money is not accelerating. That's where the financial markets are, and that's really a very tough line for the Fed to hoe. And this is what we're going to have to wrestle with. Right now, it's very clear that the markets were more than willing to give the Fed the benefit of the doubt. As I said, it's been a winning strategy, for well over a decade now. Let's see what happens today. I think markets are taking a breather, and we'll see how they digest the coming Fed speak and the numbers that they're going to generate for themselves in terms of bond prices and other external stimuli. Have a great one, everybody. Bye-bye.